Imagine waking up to headlines that your country's largest bank, one with no local scandal, no cyber attack, no insolvency, has just been frozen. But not by your regulators, not even by your own government, by a foreign power 8,000 miles away. This isn't a movie plot. It's the very real warning that global banks just received from the US Treasury. If you process transactions involving Iranian oil, especially if it's headed to China, even if the payment is made in Chinese yuan, not dollars, your entire institution could be cut off from the US financial system. No SWIFT, no dollar clearing, no Wall Street access. Nothing. This is economic warfare without a declaration, and it signals something deeper. Because the more Washington tries to tighten its grip, the faster the rest of the world is building the tools to escape it. And the next phase, it's not hypothetical. It's already happening. In April 2025, US Treasury officials didn't arrive in Hong Kong to negotiate. They came with a message, one so stark that Bloomberg and CNBC described it as the most forceful financial ultimatum in decades. Any bank, anywhere, handling oil tied to Iran, even through indirect routes or front companies, could be blacklisted, especially if that oil ends up in China, and especially if it's being paid for in renminbi. The message was clear: comply, or be exiled from the global dollar network. Within 2 weeks, the message turned into action. 9 Hong Kong-based firms were sanctioned, accused of laundering Iranian oil revenues through fraudulent shipping records linked to Iran's Revolutionary Guard. The consequences were swift, but the bigger picture is even more explosive. Because that oil isn't incidental, China now imports over 1 million barrels of Iranian crude per day. That's 91% of Iran's entire oil exports. And most of those purchases are in yuan, not dollars. The US isn't just sanctioning oil, it's trying to dismantle an emerging dollar-free trade loop between China and its energy partners. But here's the danger. With every sanction and every threat, Washington may not be stopping that loop. It may be accelerating its growth. What started as a workaround is now looking like a prototype, a test run for a post-dollar global economy. And now Hong Kong, once the neutral bridge between East and West, is being dragged into a showdown between financial superpowers. The Wall Street Journal confirmed that Treasury officials pushed banks like HSBC and Bank of China Hong Kong to look beyond surface-level companies and trace who really owns the assets and oil behind these trades, especially when payments are made in non-dollar currencies. These aren't fringe banks. They're key arteries of global trade. And what's happening now is historic. As of Q1 2025, Hong Kong processed over $260 billion in cross-border transactions, and for the first time ever, more than half of it, 54.3%, was conducted in yuan. The dollar has officially been overtaken in one of the world's top financial hubs. The US response? Extend its enforcement net beyond borders. Demand foreign banks follow US rules, even when operating outside US jurisdiction. Experts are calling it economic deputization, turning global institutions into de facto arms of the Treasury. But if these banks resist, if they choose Beijing's growing financial architecture over Washington's rules, that's not just defiance. That's a turning point. Iran's oil isn't just fueling China's factories, it's fueling a geopolitical realignment. Under their 2021 Cooperation Pact, China locked in a 12% discount below global oil prices from Iran, plus a risk premium of up to 8%. The entire agreement is denominated in yuan. It's a strategic hedge, a long-term supply chain, and a direct strike at dollar dominance. Rapidin Energy Group's CEO Scott Mell says the new wave of sanctions is meant to choke China's state-owned firms and infrastructure projects. But here's the irony. Every new measure pushes Beijing to double down. In March 2025 alone, yuan-based cross-border trade hit $725 billion, a 22% increase year over year. Bloomberg data shows the yuan now accounts for 4.13% of global payments. That's a record. And it's not just growth. It's momentum. Every new blockade from Washington pushes the rest of the world closer to building a financial system without it. The harder the US squeezes, the faster the shift accelerates. Now zoom out. You're a global company considering US expansion. You're sold on the narrative, massive consumer base, economic security, political stability. But then the data hits. Consumer sentiment, as of April 2025, has dropped to the second lowest point since records began. Inflation expectations over the next 12 months? 5.6%. That's 1981 territory. Retail and wholesale margins shrank 1.6% in just 1 month, the sharpest drop in over a decade. And that's before tariffs. Steel import prices? Up 25% year over year. Since 2023, retail profits have declined in 15 out of 17 months. This isn't an economy bursting with growth. It's one under stress. If the case for reshoring depends on a strong American consumer, What happens when that consumer is losing buying power faster than wages can catch up? Meanwhile, President Trump is promising permanence with his One Big Beautiful Bill, a sweeping extension of the 2017 tax cuts. But buried in the legal fine print is something far more explosive. If passed, it would allow the U.S. to impose retaliatory taxes on any foreign country that treats U.S. firms unfairly. What qualifies as unfair? That's up to Washington to decide. It's a potential trigger for global tax wars, just as the dollar's grip is slipping and other nations are crafting alternatives. So while the world watches the U.S. tighten its grip, sanction by sanction, it may be missing the bigger story. Because what looks like control might actually be the beginning of something else entirely. The unraveling of a financial order built on a currency the world is quietly preparing to move beyond. Fairness, as it turns out, has no legal definition, just executive discretion. And right now, that discretion sits entirely with the White House. The latest policy proposals raise the stakes for foreign companies operating in the U.S., with a 5 percentage point hike on U.S.-sourced income and a jump in withholding tax on outbound payments from 10% to 12.5%. These aren't just numbers, they're signals. Signals confirmed by the Congressional Budget Office and echoed by the Tax Foundation, which warns that these changes could slash foreign direct investment by as much as $91 billion every year. Ironically, a bill designed to bring jobs home could end up driving investment away. Because higher taxes and erratic policymaking don't build factories, they drive them offshore. Manufacturers, already wary of retaliation and global trade shocks, now face rising costs and a climate of uncertainty. Testimony from senior officials promises deficit stability, but early analysis from the Joint Committee on Taxation shows the opposite, deficits climbing across income levels. What was pitched as a magnet for global capital may ultimately become a warning sign. And while tax policy grabs the headlines, it's secondary sanctions that are quietly redrawing the global map. Designed as surgical tools, these sanctions have proven more like blunt force instruments. The Treasury warns foreign institutions that help process transactions for sanctioned countries, like Iranian oil payments routed through shadowy networks, risk being cut off from the dollar system entirely. But this fear is fueling a faster exit. China's central bank reports renminbi-based trade surged to $724.9 billion in March alone, accounting for over half of China's global trade, a huge leap from just a few years ago. The yuan is now the fourth most used currency in the world, according to SWIFT, hitting an all-time high in global payment share. This isn't just about economics, it's a strategic pivot. In April, Beijing began rewarding state-owned companies for settling deals in yuan, and officials openly criticized the global trading system as broken and distorted by tariffs. The result? Every sanction meant to isolate China or Iran is, in practice, offering the world a playbook on how to isolate the dollar. And that raises a fundamental question. If global markets stop defaulting to the dollar, what takes its place? Let's say you're the CFO of a Japanese car maker. Your US profits look strong until you convert them back to yen. In 2025, the dollar has already dropped 8.1% against the yen, wiping out margins. At the same time, you're facing higher corporate taxes, steeper withholding on payments, and increasing unpredictability. The Tax Foundation warns foreign investment could drop by $91 billion annually, and meanwhile, the U.S. labor market isn't stepping in to help. Manufacturing job growth has stalled. Inflation-adjusted wages are slipping. Tariffs are whipsawing between 10% and 30%, only to be reversed, then reimposed. The regulatory landscape is no longer just complex, it's unstable. Big players are pulling back. Bloomberg reports 246 major U.S. companies have filed for bankruptcy this year, the highest in 15 years. The more Washington tries to steer capital, the more that capital looks elsewhere. Trump's strategy is built on pressure, but pressure without predictability becomes chaos. Tariffs on Chinese imports have swung wildly in just months, and while new rates may hold through the end of the year, the damage is already showing. Chinese exports to the U.S. are down. Industrial growth is slowing. But the real concern isn't the size of the tariffs. It's the instability they represent. Economists warn that businesses are no longer just calculating costs. They're trying to predict chaos. Retailers stocked up in a panic before tariff hikes, driving up prices. Manufacturers hit pause on new projects, unsure what rules will apply 6 months from now. Even when a temporary truce was announced in May, the reaction wasn't relief. It was skepticism. Because the deeper issue isn't about confrontation, it's about confusion. And no one wants to place billion-dollar bets on confusion. Then there's the question of financial systems. Sanctioning a few oil shipments is one thing. Sanctioning entire banking systems? That's a different game. In May, the U.S. blacklisted 9 Hong Kong-based non-bank firms tied to Iranian oil networks. But it didn't stop there. Treasury officials met with banks across Asia. pressuring them to investigate dollar alternative transactions tied to Iran. And yet, despite the push, no major bank has been formally named, because to do so would risk disrupting the global financial system itself. Many of these banks are connected to US and European clearing networks. Cutting them off from dollar access could cause real systemic shock. In response, China is hedging faster. In April, it expanded pilot programs for using its central bank digital currency in trade across Southeast Asia, bypassing dollar systems altogether. Washington may be trying to tighten its grip, but in doing so, it may be teaching the world how to live without the dollar. That shift is no longer theoretical, it's happening now. Dollar dominance was never just about transactions. It was about trust, a belief that access would be fair, legal, and predictable. But what happens when that trust erodes? When allies, businesses, and global banks start wondering if access can be taken away at any moment? The more America uses financial tools as weapons, the more the world starts questioning whether the system is worth the risk. China isn't responding with tanks. It's using accounting systems, oil deals, and payment platforms. And it's finding eager partners across the world. So the real question becomes, if the global financial system fractures under the weight of sanctions, tariffs, and policy swings, what rises to replace it? Who writes the rules the next time? And will the next reserve currency be chosen because of economic strength or political alliances? Let us know what you think. Has the US overplayed its hand? Or is this the only way to maintain leverage in a fractured world? If you found this breakdown valuable, hit like, subscribe, and check out our next video waiting on your